Hey everyone, I'm Sumit Roy, and I'm on the sidelines of the Inside ETFs conference here in Hollywood, Florida. And I'm with Fran Rodilosso, who's the head of ETF fixed income portfolio management at VanEck. Fran, great to see you.
Great to see you, Sumit.
So, Fran, I have to ask you about the Fed. For a while, we thought the Fed was definitely done. They were on pause. But just today, a couple Fed officials came out and they suggested that, yeah, they might pause in June, but they might start raising again in July. What the heck is going on with the Fed?
Um, yeah, great question. I'll tell you, they've been transparent, and I think they're being transparent about the fact that they're not quite sure what the path is going forward, and that they're not ruling out further hikes because, they are not sure they have inflation under control. That being said, it's our view at VanEck that they are probably on hold for quite some time. It's also our view at VanEck that they're not very likely at all to be easing by year end because of the stickiness of inflation.
Gotcha. And of course, the market is predicting those rate cuts later this year, but it's been continuously predicting those rate cuts and it's been wrong. So you're saying the market is wrong. They're going to hold for sure.
Um, I I believe they're going to hold. In part, that involves a view, right? A view about not hitting a major bank crisis that ripples through every part of the economy, or that if we hit a recession, it is mild in nature, even if we're in the midst of it by year end. But it's not one that causes the Fed to take its eye off the inflation ball and back onto sort of the financial stability ball or employment ball.
Gotcha. So given that view, what should investors do? Because I know this year it's been so comfortable to just sit in T bills, money market mutual funds, 5% risk free. Is that the right thing to do?
Um, the issue with that is, and if you're a person who believes that the Fed will be cutting, take the VanEck view is wrong, is that you've got now reinvestment risk. So you're not going to be able to be rolling those 6 or 12 month bills into bills at similar yields in 6 or 12 months if you think they're cutting. By our view, yeah, you could hang out in short term. Now you may want to be away from direct governments for a little bit, given some of the things that are going on in Washington and potential for some disruption in payments. But aside from that, going where there's yield is not a terrible strategy right now. And there is yield at the front end. We think credit markets have reacted a little bit more aggressively than equity markets to some of the bad news out there, and that there's a little more value in credit. So adding some credit spread, but safer at the safer end to shorter term rates is not a bad place for investors to be. But they should understand that reinvestment risk is one of the risks out there.
That makes a lot of sense. And what about the long end? I think the 10-year Treasury bond yield's around 3.5%. Should we just avoid that given it's so low?
Um, you're asking someone who probably would have said avoid it when it was back at 390 to 4%. So, a lot of people did add duration earlier this year, and it was a good trade. But when 10 years got to 330, I think they backed all the way up to 370 most recently with the recent sell off. So I can see a reason for having duration in your portfolio, but probably not from a longer term total return perspective, in part because I still see a sticky inflation scenario. I don't think if you look out the curve, I think the long end of the curve is putting a lot of faith in the Fed, but there are other reasons to be out there. And again, if you have a more negative view on the economy, duration is one of your hedges, but I would pair that with some short duration stuff, lower your overall duration, have that 10-year to 30-year exposure, a lower overall duration and increase yield by owning some paper at the front end.
That makes a ton of sense. And finally, Fran, I want to ask you about the whole active versus passive debate when it comes to fixed income. Is there the opportunity to generate alpha in fixed income by using active management?
Absolutely. And more dependent upon the asset class, but there's also opportunity to generate alpha using ETFs as tools for different exposures. And through ETFs, obviously, you can get a lot of direct exposures, different parts of the curve, different levels of the credit spectrum, different structures, bonds, CLO ETFs now, some really interesting instruments. And I think it comes down to ETFs as a great tool for asset allocation, if that's your decision. But, managers in the fixed income space, active managers with good track records, good deep research teams can also add value. And, at VanEck, we have across our product suite, including fixed income, we have some active and some passive funds. And we don't have a view that one is necessarily better. It's just how are investors constructing their portfolio and what tools do they have at their disposal.
Fantastic. Well, we'll have to leave it there. Fran, thanks so much for taking the time.
Thank you, Sumit.